CM Exam Support Package Section A, Financial Statement Analysis. The first question, here we go. We have been given 4 years income statement, only the gross profit part. It says Gordon has analyzed these results using vertical common size analysis to determine trends. The performance of Gordon can best be characterized as which of the following statements? It's a vertical common size financial statement analysis, which means you have to convert these vertical numbers into percentages, taking sales as the base. So if your sale is a base 100, the cost of goods sold 750 is what percentage of sales? 750 upon 1250, that is 60%. And 60 adjusted against 100, that means gross profit is 40. You do the same for your 2. Sale is 100%, 1.3 million. 785 upon 1.3 million gives you 6.3%. And of course, the difference will be the gross profit. That will be 39.7. You do the same for the third year. 1.359 is your sales figure. Take it as 100. 825 expressed as a percentage of the sales figure 1.359. It gives you 60.7. Rounded off. And the gross profit will then come out to be 39.3%. Same goes for the last year. 1.4 million is your sales. 850 upon 1.4 million, 60.7 is your cost of goods sold. The gross profit, of course, will be the difference between these two, 39.3%. Now we have all the numbers. The options need to be matched with these percentages one by one. First, and let's move in the reverse order. Let's move in the reverse order so you get the better understanding of each option. It says the increased trend in the common size gross profit. There is no increased trend. This is a wrong statement. The gross profit percentage is falling. First it was 40%, then it's 39.7, then it's 39.3. It's a wrong statement. Gross profit is showing a decreasing trend. What about option C? The common size trend in cost of goods sold is decreasing. Wrong. Cost of goods sold is showing an increasing trend as a percentage of sales. 60, 60.3, 60.7, 60.7. So this is incorrect as well. What about B? The common size trend in sales is increasing, and this part is correct. Sales in total are going up. 1.25, 1.3, 1.359 and 1.4. Agree. First part of the statement is correct. Look at the second part. And is resulting in an increasing trend in common size gross profit margin. This part is incorrect. Gross profit is not showing any growing trend. In fact, it's decreasing. You can see. This is incorrect. Second part of the statement is incorrect, which makes this statement wrong. So what about option A? The common size gross profit percentage has decreased as a result of an increasing common size trend in CGS. Since CGS is rising, and this increase in CGS proportionally is causing the gross profit to go down. Bit longer question, but if you know how to proceed, how to go about, you will get it. So yes, A is the right answer. Shown below are components of company's financial statements. What are we required to do? What percentage value would net income be on the common size financial statement? Means net income is what percentage of sales. So take net income, express it as a percentage of sales. That's simply straightforward answer. Net income is $120,000, and this $120,000 is what percentage of your sales figure? 120 upon $600,000 times 100 is a straightforward 20%. So you can get such simple questions as well. You may get some average difficult questions, and you may get some very long question like these. So be prepared for all types of questions, because your CM exam is a mixture of easy and difficult questions. So you need to be ready for every sort of question that comes your way. So what to do with this question? Let's have a look at the requirement. Whenever you come across a bigger question, look for the specific requirement of the question. It says the financial analyst is able to conclude which of the following? Common size income statement, common size base year. So we don't know what exactly are we supposed to do. Whenever you come across a question like this, where each option needs to be evaluated, each option needs to be measured, then it's recommended to follow option by option. Let's start with option 1. What we have, what we can see, is that we have 2 years financial statements of a competitor. A financial analyst is reviewing a competitor's income statement for the last 2 years. We have the complete income statement for 2 years, and we have to evaluate each of these options in ABCD. First option, common size income statement will show operating income before income taxes at 22% for year 2. Let's try that out. This is your operating income, $25,000. It is what percentage of your sales figure? Operating income before income taxes, that is 25 upon 275, gives me 9.09%. This is 22, wrong. Statement A is wrong. B, common size income statements will show taxes related to operations at 16% for year 2. Taxes, here we go. It's what percentage of sales? 3,500 upon $275,000, that is a measly 1.27%, right? Expressed as a percentage of sales. But that's quite a massive difference. 16%. Could it be 16% of operating income? Just a guess. Just I would like to know. 3,500. We never do that in common size financial statement analysis, but that's quite a lot of difference. 1.27 versus 16%. So 3,500 upon 25,000. And then we carry 14%. Let's say even if it is expressed as a percentage of operating income, it's still 14%. So whichever way you go, this is not the right option. What about C? The common base year income statement will show that the gross profit increased by 17% in year 2 as compared to year 1. Which means this is your gross profit last year, this is your gross profit this year. So 115 versus 95,000. There is increase, of course, certainly 20,000. This 20,000 increase in gross profit is what percentage of the base year profit? Increase in profit is what percentage of base year? If you calculate, it gives you 21.05. This is again not right. We are looking for 17%. Then we have the last option. Common base year income statement will show the selling expenses increased by 14%. Selling expenses last year were 35. This year they are 40. So there is $5,000 increase. This increase is what percentage of the base year? 35,000. 5,000 upon 35 into 100, that is 14.28 if rounded off to the nearest percentage, that is 14. These are the answer. So you may come across such questions where you have to evaluate each option, and that's quite easily doable if you know what to do. You will be able to save a lot of time. These are the answer. Right. A company's financial statement from the past 2 years have the following values. What are we supposed to do? Using the horizontal analysis, what account has the largest percentage change? It didn't say largest increase or decrease, just largest change. So if you compare your sales with last year sales was 6 million, this time is 6.6 million. Yes, there has been an increase of $600,000. This increase is what percentage of the previous sales revenue? 10%. Net income was 500,000 last year, this time is 540, as you can see. 40,000 increase. This 40,000 is what percentage of $500,000? The base year. It's increase of 8%. Your last year total assets were 10 million, now it's 10.5 million. The difference is $500,000. This is what percentage of the base year total assets? Increase of 5%. So far, apparently sale revenue appears to be the largest increase. Look at the last number. Inventory last year was $600,000. This year is 500,000. There has been a decrease of $100,000. This decrease is what percentage of the last year inventory figure? It's 16.66 and so on, which is 16.7%. That is clearly the largest change downward, of course. So that's the decrease. So D is the right option. Right, here we go. In analyzing the short-term liquidity of a company, many analysts prefer to use the quick ratio, also called the acid test ratio, rather than the current ratio. Why do we prefer the quick ratio over current ratio? That's what we are trying to assess. The primary reason for this preference, why do we prefer quick ratio over the current ratio? Do we have a justifiable reason? Let's see. A, it says quick ratio excludes account receivables. This is completely ridiculous option. Account receivables are accounted for both in quick and current ratio. What is the basic difference between current ratio and quick ratio? In current ratio, we take all the current assets over current liabilities. But in quick ratio, also called the asset test ratio, we exclude two things. We exclude prepayments and we exclude inventory. And I will tell you the rationale why do we do that. So current assets minus prepayment, PP for short, and inventory figure upon current liability. That is the difference. Why do we do that? Quick ratio is called quick ratio because it considers quick assets which are readily convertible to cash, or they can be converted into cash with relative ease. Prepayments are the payments made in advance. They are not convertible to cash. Inventory takes time. So these items which are not readily convertible, we exclude them. That's the difference between current and quick ratio. So quick ratio excludes account receivable. Wrong. It excludes prepayments and inventory. B, current ratio includes marketable securities which may be impaired. Well, quick and current, they both have marketable securities because marketable securities are easily converted to cash. So they are included both in quick and current. This is a wrong statement as well. Pro forma cash flow statements focus only on cash. That's a totally irrelevant option. Cash flow statements are unrelated to what we are interested here. Because as an analyst, we prefer to use quick ratio, but this statement doesn't justify why do we prefer the quick ratio. Sometimes you get some ridiculous and irrelevant options, so be careful when you're reading. This is nothing to do with what we're looking for. So ABC cannot be the answers. Then conversion of inventory into cash is less reliable. Conversion of prepayment into cash is even more difficult. Since these two items are less reliable to be converted to cash, that's why they're excluded from the current assets, and that gives us the quick assets. And this ratio is called the quick ratio or the asset test ratio. Now we know for sure D is the right answer. Based on this information provided, the luggage manufacturer's quick ratio. Always look for what is required so that you can sift the information given in the question accordingly. Quick ratio, as we have just discussed, it excludes inventories. It excludes any prepayments. We don't have any prepayment here. So let us calculate our quick ratio. Take our quick assets, that is our 531K for cash, 439 for your account receivables, and $200,000 for your marketable securities, and divide it with your current liability, which is a single figure, $500,000. So it's a pretty straightforward question, and such questions should be done first so as to gain you certain confidence over it. It's 2.34 is the answer. Always go for the requirement. It says working capital. Now we know what to do. Now we know what to do with the information we are going to read. It says Broome Corporation has decided to include certain financial ratios in its year-end annual report to the shareholders. Selected information relating to its most recent fiscal year is provided below. We need to find the working capital. Working capital is the difference between current assets and current liabilities. I'm going to put all the current assets as plus, all the current liabilities as the negative numbers in this column that you have on your screen. Starting first with cash is a current asset to be added. Account receivable, current asset. Prepaid expenses, current assets. Inventory, current assets. Accounts payable, current liability. Notes payable, due in 90 days, that means within the current year, within the operating cycle, current liability. Bonds payable in 10 years, long-term liability. Net credit sales is never considered as a current asset or current liability. CGS is an income statement. These two last numbers are income statement figures. It's a pretty straightforward computation now. If you add the above four numbers, 10, 20, 30, 38 and 40 to 80. 80,000 is the figure for current assets, and 15, 25, 40,000 is for the current liabilities. So working capital is a nice 40,000 rounded number. A is the answer. Pretty straightforward question, and you can come across such questions if you're lucky enough. So you have got a mixture of difficult and easier questions. All of the following are affected when a merchandise is purchased on credit, except, okay, when you buy goods on credit, does it increase your total current assets? Yes, because current assets includes cash, marketable securities, account receivables, inventories and prepayments. So when you purchase inventory on credit, that clearly increases your total current asset. It's true. We need to look for the one that doesn't change. Net working capital. It is the difference between current assets and current liabilities. When we acquire inventory on credit, your current assets go up by a certain number, let's say $10,000. You buy these goods on credit, your current liability also increased by 10. So 10 increase on current assets, 10 increase on current liabilities, both increase by the same amount, net is nil. Net is nil. So it means this element B, it is not affected when the goods are bought on credit because current assets increase is offset by current liabilities increase. Same goes that if you have settled a current liability by paying money out of your cash or bank, current assets and current liabilities decrease by same amount. In that case, there is no net effect, right? So this is what doesn't affect your working capital. Merchandise purchase on credit. What about total current liabilities? When you buy goods on credit, current liabilities increase, so it will cause increase in current liabilities. C would increase. What about current ratio? Current ratio is affected because both current assets, current liabilities change by same amount, so they will definitely be affected. So the final answer, all of the following are affected when merchandise is purchased on credit. A is affected, current assets increase. C is affected, current liabilities increase. Current ratio can fall, current ratio can increase depending upon the existing form of the ratio. So it does change. What doesn't change? Net working capital. Let me just at this very point explain to you something extremely important you must know. Current ratio, quick ratio, cash ratio, whatever, if the ratio is already greater than 1. Any transaction that results in addition of the same number in the numerator and denominator will cause the ratio to deteriorate. And any transaction that results in a reduction in the numerator and the denominator by the same number, it will cause the ratio to improve. Is there any proof? Yes. Let's take a number. Let's take any ratio. Take current ratio, where we have current assets was $200,000, current liabilities $100,000. So right now current ratio is 2, which is clearly greater than 1. Let's take a transaction that causes an addition of a same number in the numerator as well as in the denominator. Let's purchase $75,000 worth of inventory on credit. If you buy goods on credit $75,000, your numerator increases by $75,000. Your denominator increases by $75,000. Same increase, decrease of the same amount in both numerator and denominator. The new ratio, as we see, is 1.57. So the ratio has decreased clearly. So when a same number is added to the numerator or denominator because of a certain transaction, if the ratio is already greater than 1, the ratio would deteriorate. Let's try it on the other side of this arrangement. What if we have entered into a transaction that has resulted in a reduction in the numerator as well as denominator by the same amount? Let's say we have paid $80,000 to our suppliers. Let's see how it happens. If we do that, we pay $80,000 to our suppliers, it will cause the numerator to decrease by $80,000 and the denominator to decrease by $80,000. Look at the massive increase in ratio. $80,000 deducted from the numerator, $80,000 deducted from the denominator. The ratio is now 6. Can you believe that? So it is very important to see whether the existing ratio is greater than or less than 1. Without computation, we can predict using these arrangements. Now let us see on the side where the current or quick ratio is less than 1. Let's say the current ratio or quick ratio or the cash ratio, whatever ratio we are discussing, if it's less than 1, any transaction that results in addition of the same number to the numerator or denominator, it will cause the ratio to improve. Vice versa, reduction will cause the ratio to deteriorate. Let us try and see, does it really work on the same set of numbers, but little change. Let's say this time our current assets are $50,000 and our current liabilities are $100,000. That means it's 0.5, which is clearly less than 1. Let's take some imaginary numbers to see what happens if the numerator and denominator, they both increase by the same amount. Let's try. Let's buy goods worth 80,000 on credit. If you buy goods worth 80,000 on credit, so what you might expect is that your numerator will increase by 80. 50 plus 80, that will be 130. Your numerator is 130. Your denominator will be 100 plus 80, 180. Now let's see what is the ratio. Now previously it was 0.5. Now it's 130 upon 180. It is now 0.72. That's clearly an improvement. 0.5 to 1, now it's 0.72 to 1. The ratio has improved. Let's see the other side. Let's say we settle our payables. We pay 30,000 to our suppliers. That will cause a reduction of 30 in the numerator as well as in the denominator. So the new numerator would be now 20,000. The new denominator will be 80,000. So it's 70,000. So 20 by 70, the ratio drastically falls to 0.29. So please, this is an important conclusion to be fixed in your memory. If the ratio is greater than 1, same number, numerator, denominator will cause the ratio to deteriorate, vice versa, improvement, and then we have a complete opposite when the ratio is less than 1. So keep that in mind. It is very useful trick to do the computations quickly, and that is rightly used here. Okay, it says Birch Products Incorporated has the following current assets: cash, marketable securities, account receivables, inventories, total current assets 2.6 million. If Birch current liabilities are 1.3 million, which of these is true? First of all, we don't have to calculate each one of them. We will apply the concept we just learned. Your total current assets are 2.6, current liabilities are 1.3. So our current ratio is straightforward 2, which is greater than 1. 2.6 upon 1.3, that is 2, which is greater than 1. And if you talk about the quick ratio, because the question also discusses quick ratio would exclude inventory figure, and that will be only 800,000 plus 100,000 plus 250, 1.15 million upon 13, that is 0.88. So your quick ratio is 0.885, which is less than 1. So we will apply the same dynamics we learned previously and test each of these one by one. It says current ratio, if a payment of 100,000 is used to pay 100,000 of account receivable, current ratio will decrease. Let us just put the same scenario we have discussed previously. If ratio is already greater than 1, this is what we observe. Otherwise, that's what we see without computations. And if the ratio is less than 1, we see an increase here and decrease. So without any computation, we can quickly get our numbers. So in case of the current ratio will decrease if the payment of 100,000 cash is used to pay 100,000 of accounts payable. See, this part is applicable. Reduction of the same amount from numerator to denominator, it will cause the ratio to improve, not decrease. This is wrong. It would increase rather. B. Current ratio will not change if a payment of 100,000 cash is used to pay 100,000 of accounts payable. Wrong. It will increase. This right here. Quick ratio will decrease if a payment of 100,000 is used to purchase inventory. If you buy inventory paying cash, it is not explained here, but you can get the idea. We know the quick ratio is cash, marketable securities, and your account receivables upon current liability. If you use cash to buy inventory, your cash reduces. There is no corresponding increase anywhere. You have bought inventory. Inventory is never reported as a part of quick assets. So resultantly, your numerator falls, and that fall in numerator will cause the ratio to decrease. So this is exactly what would happen. Correct option. Quick ratio will not change. No, it will change if you buy on credit. If you buy on cash, your cash is reduced. and that causes the current ratio to fall. C is the right option. So such questions can take more time, but be careful how to reduce your computational time. The quick ratio at the end of the year, that means you need to focus only on these numbers. Quick ratio means you need to consider your cash, marketable securities, account receivable. Total of these divided by the current liabilities, which is accounts payable and accrued liabilities. Just these two. So 62 plus 35 and 47 gives you a total of $144,000, and 84 plus 11, that is $95,000. And simplification is 1.515, which is 1.52, and the perfect match with your option D. Perfect. See here, it says Davis Retail Incorporated has current assets of 7.5 and current ratio of 2.3. Current ratio is greater than 2. Or in other words, as we have taken it, greater than 1. 2.3 means greater than 1. So that means if the same number added to the numerator and denominator will cause the ratio to deteriorate, and conversely speaking, improve. It says this is the ratio before purchasing $750,000 of merchandise on credit for resale. After this repurchase, what happens? When you buy $750,000 worth of inventory, it will cause your numerator to increase and denominator to increase by same amount, because inventory appears on the numerator, accounts payable appear in the denominator, both increase by the same amount, the ratio will deteriorate, so it will be lower than 2.3 for sure. Some of you who may not be able to remember this computation can try another way. First of all, you need to find out if the current ratio is 2.3, what would be the figure for current liability? Let's do that. 2.3 is equal to current assets, which is 7.5 million, over current liability. Solving this will give you current liability of 326,870. Now we have the exact numbers. Our current ratio is made up of 7.5 million of current assets and 3.260870 millions of current liabilities. Now let's apply the number. It says we have purchased merchandise worth 750 on credit, which means 750 is added to the numerator as an inventory number and 750 is added to the denominator as a accounts payable. Now if you simplify this, it reduces your current ratio to 2.05. See, ratio has fallen. So this is a quicker, shorter way. You may go this way if you forgot the arrangement of these things. Next, Graska Auto Parts must increase its asset trust ratio above the current 0.9 level. That tells you immediately current or quick ratio whenever it is less than 1. We have this arrangement. Addition of same number causes the ratio to improve, and that's what you have if there is a reduction. Right, let's see each option one by one. So it says right now the current ratio, asset trust ratio is at 0.9. Let's read. Graska Auto Parts must increase its asset trust ratio above the current 0.9 level. This is the current quick ratio. And we need to increase it to above this number to comply with the terms of the loan agreement. Which of the following actions is most likely to produce the desired result? We want to improve this ratio. So we need to do something like this, or something else that causes the ratio to improve. Let's see. Expediting collection of accounts receivable. It won't affect, because when we expedite collection from your account receivables fall, your cash increases, but the total current assets stay the same. It will not improve your quick ratio, because it is simply reclassification of current asset account. Selling auto parts on account. Yes. When you sell your auto parts on account, it will cause your account receivable to increase. Why? Because remember, in quick ratio, we have three things on our numerator: cash, marketable securities, and account receivables upon current liabilities. So when you sell auto parts on credit, your account receivables go up. Yes, there is a reduction in inventory, but that is not reported in quick ratio. Right? It's in the current ratio. So here we have a single change in our account receivable on numerator that causes the ratio to improve. That's exactly what you should do. Sell auto parts on account, or otherwise buy goods on credit. This way also you are able to improve your quick ratio. What about option C? Making payments to trade accounts payable. That will even deteriorate the ratio. If you make payment to your suppliers, you deduct same amount from numerator and denominator, the ratio deteriorates. We don't want that to happen. Purchasing marketable security for cash, it will have no effect, neither increase nor decrease, because marketable securities level goes up, your cash falls. So it's simply adjustment within the numerator, total numerator stays the same. So the right option is B. The owner of a chain of grocery stores has bought a large supply of mangoes and paid for the fruit with cash. Immediately you should jot down what has happened. Stock goes up or your inventory level goes up and cash goes down. So this purchase will adversely impact which of the following? Working capital stays the same because cash has reduced, stock has increased, so working capital in total stays the same. Current ratio may go up, may go down, we don't know. Mostly our current ratios are greater than 1. Mostly, in most of the business, current assets are more than current liabilities. So mostly it is greater than 1. And if it is so, any change in numerator, denominator of the same amount will cause the ratio to deteriorate. Right? So, but what we have done here, we have simply reclassified our stock into cash, or cash into stock. It's just the change in numerator. So it's not going to impact. There is no change in numerator denominator at the same time. Right? So we can't say it's B. Asset test ratio. Asset test ratio has cash, marketable securities, and account receivables over current liabilities. Since we have used cash to buy stock, cash has reduced and there is no further change because there is increase in inventory, but that's a part of current ratio. So overall your numerator falls and that makes the whole ratio to fall, and that's the problem here. This purchase will adversely impact which of the following ratios? Asset test ratio, quick ratio. Price earning is totally irrelevant here because price earning ratio is the ratio of market price per share over earning per share. It has nothing to do with what we are discussing here. So got the answer? C. Which of the following, when reviewing a credit application, a credit manager should be most concerned with applicants, which of the following set of ratios? Let's discuss one by one. Remember, you are a credit manager and you are reviewing a credit application, assessing should we grant credit or not. So what you are most concerned with? Profitability and return on assets? No, I'm not concerned. Profit margin and return on assets show profitability, not liquidity. I am concerned with liquidity. I want to ensure that my customer will pay me on time. I'm not concerned with profitability. Price earning ratio again is wrong. Price earning ratio is market price per share over earning per share. Not concerned because this is a market measure, not useful for credit risk that I am interested in. Not the right option. C. Working capital and return on equity. First part is fine. It's a part of liquidity measurement, but second part is not. Return on equity, it is a profitability ratio for owners. It's not the ability to pay debts. Exactly. That's what I'm interested in. Working capital and current ratio. Yes, excellent. Both of these measures I will use to assess the short-term liquidity and ability of my customer to pay on time. So that's what I'm interested in. Absolutely. All of you got it right. That is correct. Okay. Both the current ratio and the quick ratio of Spartan Corporation have been slowly decreasing. For the past 2 years, the current ratio has been 2.3 to 1 to 2 to 1. Current ratio for both years has been 2.3 to 1 and 2 to 1. During the same period, the quick ratio, QR for short, has been from 1.2 to 1 to 1.0. The question says the disparity between the current and quick ratios, there is a gap of course, can be explained by which of the following. We know very well that there are two elements that cause the difference between current and quick ratio. One is the prepayment, other are inventories or stock items in your warehouse. These two. So let us analyze each one of them. The current portion of long-term debt has been steadily increasing. If so, this is true for both ratios. The cash balance is unusually low. If so, this is for both ratios. We want to see what is causing disparity. The disparity is that the company has unusually high level of inventory balances, and this is one of the causes that results in disparity between these two ratios. Right? Remember, prepayments and inventory. Account receivable is the same for both, though both appear in the numerator. The asset test ratio, also called the quick ratio, shows the ability of the company to pay its current liabilities without. The asset test or quick ratio is calculated this way: cash, marketable securities, and your account receivables expressed as a fraction of current liabilities. So it measures what? Without having to do what? It reduces cash balance. Cash balance is on both ratios, current and quick. Cash is a part of quick assets. We use cash to settle liabilities. Borrow additional funds. Incorrect, because this ratio measures existing liquidity. We don't talk about borrowing more funds. Collect receivables. Receivables are included in quick ratio and current, both ratios. Our concern is that asset test ratio measures our ability to settle our current liabilities without selling our inventory, because inventory is not a part in this ratio. That if we have to settle our current liability, how much current assets do we have without inventory figure? And these are the three numbers. Right? So you need to read carefully. Quick ratio excludes stock or inventory because it shows you how well a company can meet short-term debts without selling your stock in trade or inventory figures. Next, short question again. All of the following are included when calculating the asset test ratio, except what is not included. 6 months treasury bills, it's like marketable securities, it is included. Treasury bills are highly liquid. Prepaid insurance are not included. This is not included. Inventory is not included. Account receivables is included because it is expected to be collected soon. 60 days certificate of deposit is short term and it's a near cash asset, it is also included. So this is excluded. Prepayments and inventory. What are we required to do? Asset test ratio. For this, we need to take the quick assets, which is cash, account receivables. Prepayments are not considered. Inventory is not considered, just two numbers, divided by the current liability, which is accounts payable and notes payable. So basically it's 10 plus 32. 42 over 40, so that is 1.05. Fairly straightforward. Speed and accuracy is what you need to do well on your exam. If a company has a current ratio of 2.1 and pays off a portion of its accounts payable with cash, what will happen? Here we would use that arrangement. If the current ratio or the quick ratio, whatever we are considering, is greater than 1, and a transaction that causes similar change in numerator denominator, it causes the ratio to deteriorate, and a reduction will cause the ratio to improve. So what is happening here? It says a company with current ratio greater than 1, 2.1, pays off portion of its accounts payable, which means same amount is deducted from the numerator as well as denominator, so the ratio would improve, ratio would increase. Without calculation, we come up with a solution that it would increase. Next, on the basis of the information provided above, which company has the highest relative likelihood of defaulting on an outstanding loan? For this, we will calculate a ratio that involves interest and interest expense, earning before interest and interest. Let's see the whole story. A banker is reviewing the bank's current portfolio of outstanding loans and collected the following financial data on 4 companies that the bank has loaned money to. Company A, B, C, D. Each has provided its earning before interest and tax and interest expense. When you have these two numbers, you will use a measure called the times interest earned, or sometimes called the interest coverage ratio. Interest coverage ratio. It's equal to earning before interest and tax upon the interest expense. So it's fairly straightforward. 5,000 upon 3950 is 1.266. For company B, 12.5 thousand upon 9,000, it's 1.389. For company C, 4,300 upon 2675, it's 1.607. And for company D, 245 upon 125 is 1.96. Now, what is the interpretation? If there is $1 liability to be settled for an interest expense, company A has $1.26 of profit, B has 1.38, C has 1.6, and D has 1.96. Which company has very little income to cover the interest expense? A. For every $1 of interest expense, company has only $1.26 of earnings. So the company that is most exposed to the risk of default is company A. Absolutely, all of you got it right. Next, an accountant has determined that last year the company had earning before interest and tax of $750,000. Earning before interest and tax, $750,000. And interest expense was $125,000. What was the company's degree of financial leverage? Degree of financial leverage is calculated using this formula. Formulas must be on your fingertips. Earning before interest and tax over earning before tax. That means pre-tax, pre-interest income. You can also call it pre-interest income. That means income before interest, and post-interest income. That is income after interest. So we want to see what is the effect of interest. If we do not deduct interest from our income is 750. But once the interest is paid, which is 125, it falls to 750 less 125, that is 625. See the impact. Before interest, it was 750. Once interest is paid, it is 625. It has fallen, and the degree is 1.2. That is B. Perfect. All right. Which corporation is the most highly leveraged? Which has more debt? So all has been given are the relative percentages. The capital structure of 4 corporations is given below. So what we see, long-term debt is 40% for Sterling, 35% for Cooper, 30% for Warwick, and 30% for Payne. The company that has the largest proportion of debt is Sterling. Sterling is the one that is facing the highest risk of default because it has the highest proportion of its funding coming from long-term debt. Based on the above information, Sahara's degree of financial leverage, we just learnt a little while ago, degree of financial leverage is equal to earning before interest and tax upon earning before tax, means pre-interest income over post-interest income. Let us find out the pre-interest income. For this, we take your sales, less cost of sales, less operating expenses. That is earning before interest, which is $3 million. And then you calculate your post-interest income. Deduct 800,000 interest from your income, you get earning before tax, EBT. That is 2.2 million. So serving this as a denominator means what you get 1.3636. That's degree of financial leverage using EBIT and EBT, and it perfectly matches with your option B. Next, a degree of operating leverage of 3 at 5,000 units means what? Please remember, whenever you are given degree of financial leverage in percentages, let me take you back. This formula used but in the reverse order. You use degree of financial leverage, percentage change in earning before tax over percentage change in earning before interest and tax. This order is reversed in the percentage format. I'm sure you would know if you have read your leverage topic well. Let's see, do we have these, or are we given sales figure? We have been given sales. We have been given the sales number. Look at this, sales. Sales. For sales, there is a little discussion before we can solve this question. Degree of financial leverage is normally calculated as earning sales divided by earning before interest and tax. But in the percentage version, we take degree of financial leverage is equal to percentage change in earning before interest and tax divided by percentage change in sales. It's opposite in the order, right? That's an important point to be noted. Here, if EBIT upon EBT is given in the simple dollar-based numbers, in percentages it is reversed. Same is true for this, if you have read the theory and attended the lecture on this topic. So, this is the one we will be using. It says if the degree of financial leverage is 3, what does it mean? A 3% change in earning before interest and tax will cause 3% change in sales. What we see here, if sale is the driver, a 1% change in sale will cause a 3% change in earning before interest and tax. If sale changes by 1%, the EBIT changes by 3%. That is what is meant by DFL of 3. And this perfectly matches with this option. 1% change in sales will cause 3% change in earning before interest and tax. And that's how it's verified. Know your formula as well, because financial statement analysis is all about formulas and their interpretation. Next, firms with high degree of financial leverage would be best characterized as having what? Which of the following? Let us discuss each option one by one in the reverse order. Please note what is required. Firm with high degree of financial leverage would be best characterized having which of these options in the reverse order? High fixed charge. What is fixed charge? Like interest coverage. Let's say I have earning before interest and tax of $100,000. Interest is only $5,000. Look at this. 20. If a company has high fixed coverage ratio, high interest coverage, that means company has lower degree of financial leverage. This is an indication of low degree of financial leverage. We are looking for the one that has a high degree of financial leverage. D is not right. Low current ratios. Current ratios measure liquidity, not leverage. Wrong. Zero coupon bonds in their capital structure. Zero coupon bonds are those bonds where the company doesn't pay interest. Rather, the bonds are issued at a discount. Like a bond with a face value of $1,000 is sold for $910, and when the bond matures, company pays $1,000 full. The difference between what the company got versus what the company is paying is the effective interest cost of $9. So $90. Right? So zero coupon bond itself is a type of debt, but they don't define leverage by themselves. Yes, high to debt to equity ratio, debt upon equity. If debt is bigger proportion of the total funds available, that is what you call the degree of financial leverage being high, and that is exactly what are we looking for. All of you got it right. Correct. Very good. The use of debt in the capital structure of the company. Like when we want to design our capital structure, we may originally plan 30% debt, 70% equity. But with the passage of time, we might end up having more debt, maybe 60% debt, 40% equity. So that means we are now more financially leveraged. So when you use debt in your capital structure, it increases your leverage. It's a trouble, not a good thing. It increases risk. Let us see each option one by one in the reverse order. So when you have more debt in your capital structure, when you use debt in your capital structure, it decreases operating leverage. It has nothing to do with operating leverage. It has to do with financial leverage. Operating leverage is not affected by financing choices. Operating leverage is driven because of fixed cost. Decreases financial leverage? No. Use of debt increase the financial leverage. Debt increases operating leverage? No. Operating leverage is influenced by fixed cost in your operations. So then what's the right option? If you use debt, it increases your financial leverage because you are now exposed to more risk where you have to pay certain interest payments despite the fact you may not have any profit at all. Right. A financial analyst with Minerals Incorporated calculated the company's DFL as 1.5. Degree of financial leverage is 1.5. If net income before interest and tax increases by 5%, earnings to shareholders will increase by, that is earning before tax. That's what we're interested in. So the percentage formula, I would write it again so that you know what exactly we mean. Degree of financial leverage Normally we calculate it this way, earning before interest and tax over EBT. In percentage version, DOFL, it is reversed totally. Percentage change in earning before tax upon percentage change in earning before interest and tax. Always remember that. Now the problem is we do not have EBT probably. I think in this question it states as net income. So in these situations when EBT isn't available, then EBT can be approximated for net income. So the formula we'll be using now for understanding DOFL in this case is percentage change in your net income over percentage change in your earning before interest and tax. Percentage change in earning before interest and tax. Know your formulas well. So it says a financial analyst, this is the formula we'll be using. A financial analyst with Minerals Incorporated calculated the following degree of financial leverage as 1.5. If net income before interest and tax increases by 5%, earning to the shareholders, which is basically a net income, how would it be affected? So 5% will go there and will cause, did I use the formula correctly? Net income before interest and tax, that is basically EBIT. So 5%, this is the income that is attributable to the shareholders for dividend purpose. So if there is a 5% change in EBIT, the income available to the shareholders would increase by 7.5%, and that is option D. Next, bit longer, each option needs to be weighed carefully. It says which of the following statements concerning the effects of leverage on earning before interest and tax and the earning per share is correct. Every option must be read very carefully. It's a very tricky question, and the question like these are the one that cause trouble in the exam. So each option has to be thought about. You can't just simply jump on every option. Let us move in the reverse order. Indeed says financial leverage affects both EPS and EBIT. Financial leverage affects earning per share, but it doesn't affect EBIT. Why? Because EBIT is earning before interest and tax. Since this income has no impact of interest, hence financial leverage cannot affect EBIT. This part only results in rejection of this option. However, second part is correct. Operating leverage affects EBIT. Financial leverage affects EBT, not EBIT. Because interest is what is the effect of financial leverage. So please remember, financial leverage affects EPS, it affects EBT, it affects net income, but it does not affect EBIT because this is the income before interest. So first part is wrong, second is correct, but the whole statement and then is wrong. C. It says if a company A has a higher degree of operating leverage, it has more fixed cost than company B, and company A offsets this by using less financial leverage, then both firms will have the same variability in EBIT. It's wrong. EBIT is influenced by operating leverage only. It cannot be offset, cannot be reduced or changed by financial leverage. This statement is incorrect as well. What about B? A decrease in the financial leverage. If a company lowers its financial leverage, takes less loan, it will increase the beta value of the company. Wrong. Beta value would also decrease because when financial leverage reduces, it reduces the risk of the business. And when risk of any business falls, it causes the beta to fall, which is the measure of risk for a certain company. So this statement is wrong as well. Then the correct option must be A, and let's see, do we have the good reason for that? For a company using debt financing, a company that uses loans, a decrease in EBIT will result in proportionally larger decrease in EPS. This is absolutely right. This is an absolutely right statement because if a company uses a lot of debt, let me explain the whole through a flow. If you use debt, it results in higher figure of interest expense. This interest expense reduces your earning before tax. This reduction in EBT results in lower of money available to the shareholders, EPS falls. Right? So increase in interest reduces the money available to the shareholders. So for a company using debt financing, a decrease in EBIT will result in proportionally larger decrease in EPS. That's the correct option. Which of the following is the best indicator of long-term debt paying ability? Let us move in sequential order. Working capital turnover, wrong. Working capital turnover measures short-term efficiency. It's an efficiency ratio. It's an activity ratio, right? Assets turnover, again, assets turnover shows how effectively assets generate sales. It's a measure of activity, not solvency. Current ratio, again, it's a measure of short-term liquidity, not long-term solvency. Debt to total assets, yes. That's the right option because it shows the proportion of company assets that are financed by debt. What does it mean? It means, let's say, if you have $1 million worth of assets and debt is $600,000, this is exact explanation of the ratio, debt over total assets. That means out of the total 1 million assets you have, 600,000 have been funded by debt. Remaining 400,000 has come from equity, right? So it shows you the proportion of company's assets financed by debt, and that's the ratio that indicates a company's long-term debt paying ability. If you have more debt comparatively to the assets available, that means your debt paying ability is less. You are in trouble. And compare it with the situation where you have got just a tiny $50,000 long-term debt, 1 million assets. That means remaining $950,000 has come from your equity. So that means your long-term debt paying capability is good. Bigger, longer question. If you come across a question like this, it's always advisable to see what is specifically required. Based on the information, select strategy that would fulfill the objective. No, didn't help. Objective of what? So in this question, the requirement is not very precise. What are we looking for? It says Eastern Bank has received loan applications from 3 companies in the computer service business, and it will grant a loan to the company with the best prospect of fulfilling the loan obligations. So we are a bank. We have been approached by 3 possible applicants for the loan. We will grant loan only to the one company, maybe because of a limitation of funds available. So forget about the question. If I'm a banker, I would like to extend a loan to the company. I would like to see 2 important things. First, solvency, leverage and liquidity. I'm concerned with whether the loan seeker, the borrower, will make the payments on time. So that is what my objective would be. Now we know exactly. Select the strategy that would fulfill Eastern's objective, that the customer doesn't default on the loan. Specific data shown below has been selected from these applications for review and comparison with the industry average. So industry average tells us sales is 4.3 million on average for the companies in this industry. If this is the benchmark, the company that is exceeding the benchmark is Sysgen. Net profit margin, industry average is 9.65. The company that is beating the margin is Sysgen. Current ratio, industry average is 1.95. The best, Astor. Current ratio, bigger the better. Return on assets, industry average is 12.4, and the company that is beating. Debt to equity ratio, a measure of solvency. The lower the better. So the company that has the lowest debt to equity ratio is Astor. And financial leverage, lowest for Astor. So what we see is that this company is the most suitable applicant amongst all. Now let's see the options. Eastern should not grant any loans as none of these companies represents a good credit risk. Wrong. Astor appears to be a very good credit risk. Grant the loan to CompoGo as all the companies' data approximate the industry average. See, we do not want the company that approximates the industry average. We want the one that is beating the benchmark, doing better than the industry. So again, this is not right. Grant the loan to Astor as both the debt equity ratio and degree of financial leverage are below the industry average. See, excellent. This is what we should do. And why not? Because it represents low level of financial risk. D. Grant the loan to Sysgen as the company has the highest net profit margin and degree of financial leverage. Degree of financial leverage being high is not good. We need the one that has a lower degree of financial leverage. It's a measure of risk. Right? So we got the answer. C is the correct option. What is needed? Debt to equity. Fine. The following information has been derived from the financial statements of Bothwell Company. Current assets are given, total assets are given, long-term liabilities are given, and the current ratio is given. We need to find out the debt to equity ratio. Debt over equity. The problem is we don't have, because the total formula, in its expanded form, it is total debt over total equity, or just equity, common equity. We just have long-term debt, and equity is totally missing. So it means first we have to find the missing numbers, only then we can proceed. So we would start from the current ratio. We know current ratio is equal to current assets upon current liabilities, which is equal to 3.2. That means current assets we already have 640. Current liabilities we want to find out is equal to 3.2. So current liability will be equal to 640,000 upon 3.2. Its simplification would give you $200,000. So we got our current liability. So now, do we have long-term liability? Yes, long-term liabilities plus current liabilities gives you a total of 330. Do we have total assets? Yes. If we use the accounting equation, assets is equal to liabilities plus equity, we can find out the missing link. Assets in total are $990,000. Liabilities in total 130 plus 200, that is 330. We got the missing link. We got equity. Equity is equal to 990 less 330, that is 660. We got everything we needed. We got the total debt of 330. We got total equity of 660. So we got what we needed. Total debt is 330, current and non-current combined, and total equity is 660. So debt over equity is 0.5. That is A. Perfect. Bigger, longer question. Marge Halifax, Chief Financial Officer of Strickland Construction, has been tracking the activities of the company's nearest competitor for several years. Among other trends, Halifax has noticed that this competitor is able to take advantage of new technology and bring the products to the market more quickly than us. In order to determine the reason for this, Halifax has been reviewing the following data regarding two companies. So, comparing our results with our competitor, our account receivable turnover is slow. Competitors having high, that means better. We are better. The bigger, the better number. Current ratio, debt to equity ratio, lower the better. Degree of financial leverage, lower the better. And pricing ratio, higher the better. So we good. We are much better than our competitors. Why are we still lagging behind? Why are we slow in bringing the new product in the market? On the basis of this information, which of the following is the best initial strategy for Halifax to follow in attempting to improve the flexibility of Strickland? Remember, Halifax is, and he is his company's numbers with the competitor's business number, and company is profitable, company has good liquidity, company has low leverage, solvency is good, but still we are not competing well with our competitors. So what is wrong? What is wrong basically? Why are we not good at competing with our competitor? Why do we bring the product? There should be some good reason. Let's see. We don't find answer in profitability. Our competitor has more financial, borrowed money from the banks. He has less liquidity, has more debt, means he is using debt in business operations. He is using debts efficiently, considered bad. But if you borrow and use the borrowed money effectively, let's say I borrow money from the bank at 6% rate. I deploy these resources, productive use, and generate, say, 30% return. Look at that. This is the return I have generated, and I have to pay 6% fixed interest to the bank. right? So that is how we use borrowed money, generating more returns to the lender. So let's see what they should do. What is the initial strategy? Seek cost-cutting measures that would increase Strickland profitability. This is not right. We are all more profitable. Look at this return on assets. We are better than profitability. Profitability is investigate ways to improve and turnover times to improve liquidity. With better liquidity than our competitors. Liquidity. Problem is that we are not borrowing, and hence we are not able to use those funds to bring or invest in new technology so as we can bring. That's the main problem. Seek additional funding for new products introduction. Borrow is not bad if you are able to use borrowed money in most productive. Use it to bring new technology, bring new products to the market better and in a quicker fashion than your competitors. That's what you need. That's the right option. What about D? Increase Strickland's investments in short-term securities to increase current ratio. Current ratio is already better than the competitor. That's not an issue. Issue is that we are shying away from loans. Loans are not bad if we are able to make good use of them. Next, collected the following financial data on 3 companies that only purchase their products for sale to retail consumers. Company AC, we have been given sale for each of the companies, gross profit, beginning inventories and ending inventories for each. What is needed? On the basis of information, the supplier is able to conclude what? Inventory turnover. Most likely it is all about inventory turnover. See what we know just from the options given: inventory. So what we have ending and opening inventories, and we have sales and gross margin. That means we can find CGS also. So basically it's all about inventory turnover. We need inventory turnover. The question doesn't specifically say so, but that the word inventory is pointing that we need inventory turnover. So let us first find out what is the CGS for each company. If sales is 1 million and gross profit, that means CGS would be 80% of sales. That means $800,000, 800,000 pounds basically. For company B, gross profit margin is 30%. That means CGS would be 70. 70% of 1.25 million is 875. And for company gross profit margin is 25%. 75% would be CGS. So 75% of 2.45 million is 1.8375. Right. So we got CGS. Can we find our average inventory? Is pretty straightforward. 65 plus 35 over 2, 80 plus 2 to 5 over 2, and 150 plus average. The formula we use for inventory turnover, it's equal to CGS, which we have for each company, divided by the average inventory figures. So let's do it right in the last line. Inventory turnover ITU is equal to 800,000 pounds for A. Average inventory will be 35 plus 65, 100 upon 2, that is 50,000. For B, pretty straightforward questions, more computational, but perfectly manageable. 875,000 divided by the average figure is 80 plus 2 to 5 over 2, 152,500. And last, CGS 1.8375 million divided plus 175 to 165, 330. Now if you calculate the inventory turnover each of these, for A it's 16, for B 0.73, for C it's 11.136. Now let's see what is the right. Company B is turning the product. No, company B is in fact the slowest. Company C is turning the product inventory the fastest. No, it's turning the inventory to sales fastest. Company B and C are both turning the inventory faster than A. No, best. A and C, they are both better in turning the product inventory into sales in company B. This is absolutely right. So it was, there were 3 questions packed in one. We had to calculate inventory turn for all of these. Next question. Right. A financial analyst is analyzing account receivables period for days sales in receivables, which you call the average collection period. Financial analyst has collected the following information for the companies. We have net credit sales for all these three companies, average account receivables net of allowance, and allowance for credit losses is given for each company. Right. If each of the companies has credit terms of net 30, means the payment is to be, the financial analyst is most likely to conclude to calculate either the average or we may have to calculate inventory turnover, whichever you can is perfectly fine. Please remember, when you calculate account receivable turnover at gross receivables, so if you have been given the account receivables net, you need to add the allowance figure back to find the gross figure. So you need to add two numbers and then use that to find out your average collection period or account receivable turnover. It will be 13,500 for A, it will be 500 for B, and it will be 16,000 for C. Right? So let us see which company is able to turn its receivables quickly. So rather than calculating in, you can do it much quickly by just simply dividing your sales figure with this. 175,000 divided by 13,500 gives you 12. 105,000 divided by 26,500 gives you 5.47. And then 225 upon 16,000, that gives you 14.06. So what basically it is, that company A collects money 13 times in a year from its customer. Company B collects only 5 times in a year and 14 times in a year. So it means C is the most, if company B is the least efficient. Got our answer, but let's say if you list that we should convert into days, you can do that. 360 day a year, so 360 divided by 12.96, let's do that. 360 divided by 12.96. It gives you 27 days, 27.78 days. 360 divided by 5.47. 65.81 days, terrible. And for the last one, 360 divided by 14.06, 25.60. Since 30 days was the benchmark, of these, A and C are collecting within 30 days. The problem is with B. So company B is the least efficient. This is more, understandable. Account receivable turnover ratios to be calculated. So what we have, Maydale Incorporated financial statements show the following information. We have account receivables opening balance, account receivables closing balance, and credit sales for the period. So we are required to find out account receivable turnover. We know the formula, account receivable turnover is equal to sales, which is $3.6 million, credit sales ideally, divided by the average receivables. Average receivables will opening plus closing over 2. So it's going to be 320 plus 400, that is 720 upon 2, that is 360,000. Great. So your account receivable turnover is 10. Means your customer pay you 10 times in a year. 10 times in a year. You've got the answer, but let's say if you need to find out after how many days do they pay us, average collection period is equal to number of days in a year, which is normally 360 or 365, divided by your account receivable turnover. That means on average your customers pay you in 36 days. Right? Yes, you're absolutely right. If the question is silent, you're right, excellent. If the question is silent, always use 365. 365 over 10, that is more dependable and more accurate answer. If the question is silent, always use 365. So for now, we got the answer. The customers pay you 10 times in a year. Correct. Using a 365 day a year, the company's days sales outstanding in receivables, or simply average collection period. We know the formula. Average collection period is equal to average account receivable upon ideally credit sales if possible, multiplied by the days that we should use is 365. So do we have credit sales? Excellent, that's right here, 220. Do we have opening and closing receivables as per the question requirement? Yes, this is it. 20, 24, 44, 44 over 2, that is 22,000. That's all. All other information, if you read, you will simply be wasting your time. Don't do that. Just get what you have. Account receivables, average figure is $22,000. Credit sales is $20,000 multiplied by 365. If you simplify, you get exact 36.5, which is C. Zubin Corporation experiences a decrease in sales. Okay, decrease in sales, decrease in cost of goods sold, and an increase in account receivables. And no change in inventory. If all sales is held constant, what is the total effect of these changes on the receivable turnover and inventory ratios? Do not just guess. Simply write down the formula. Inventory turnover is calculated using this list. Cost of goods sold over average inventory. You just put inventory. Receivables turnover, that is credit sales or just sales over average account receivables. Now try to assess what is it. It says sale is decreasing. If sale is decreasing, this is what we have. Cost of goods sold is decreasing. An increase in account receivables. Account receivable is increasing. Inventory level is not changing. Without any numbers, you have the formulas. Now you can easily predict that if cost of goods sold is falling, inventory is the same, this ratio will decrease. Sale, the numerator is decreasing, denominator is increasing. As per the question's information, this ratio will decrease. See, there were no numbers, but using the formula we were able to conclude that inventory turnover as well as receivable turnover, they're both decreasing. Excellent, Riyaz. D is the answer. Inventory turnover ratios for the year. Immediately the formula comes into our mind is cost of goods sold over average inventory number. Do we have CGS? Let's read the question. Peggy Bonhan, controller, has gathered the following information regarding Lampasso company. We have opening closing stock, opening closing receivables, opening closing payables. Total sales for the year 85,900, of which this is credit, and the cost of goods sold is 24,500. Let's plug in the numbers. CGS is 24,500 given right here. Average figure for the inventory. Opening 6,400, closing 76, opening plus closing over 2. That will be 14 over to 7,000. So 24,500 over 7,000, that's 3.5. So that is exactly what we were looking for. I keep on saying, and I'll keep on saying, look what is required. It will save you a lot of time. Inventory turnover. Simply, I need CGS over average inventory number. That's all. I just need CGS right here, which is given as opening stock plus purchases minus closing stock. That's the number I need here. And I need average stock. Do I have it? Yes. 125 is the opening stock, 138 is the closing. Opening closing upon 2 gives me a total of 131,500. Finished. See, I've saved a lot of time for myself. CGS is $527,000. Average inventory figure is 131. I wasted no time in looking at GP operating expenses. They are all time wasters. Look at question specific requirement, plug in the numbers, and there you go. Excellent. So 5 to 7,000 upon 131,500 gives you 4.0076, which is approximately 4.01. C. Perfect. All you got it right. Excellent. Next question says inventory turnover for the year in time. So again, we're looking for CGS and average inventory figure. Rest of it is just time waste. Let's see. Do we have CGS? Yes, right here. Do we have average figure for the inventory? Right here. Opening and closing. See, you save a lot of time and every second counts on your exam. 30 plus 26, that's 56 over 2, 28,000. So your CGS is 140 and your average inventory figure is 28. So 140 over 28 gives you 5, perfect match for your option B. See, you save a lot of time. This question will take some time because you have to think about information given. Globe Trade is a retailer that buys virtually all of its merchandise from manufacturers in a country experiencing significant inflation. Inflation is increase in price levels. When the prices are generally rising, we say the country is facing inflation. Inflation is the growth in price levels. Globe Trade is considering changing its method of inventory valuation from first in, first out to last in, first out. Last in, first out is permissible under the US GAAP. What effect would the change from FIFO to LIFO have on current ratio and the inventory turnover. First of all, current ratio is current assets upon current liabilities, and inventory turnover is CGS upon inventory figure. Right? We have two systems. First system was FIFO. Now we are moving from FIFO to LIFO. Now please see, when price level is rising, our concern is what will happen when we move to LIFO. Only LIFO is concerned. If you wish to, you can calculate for FIFO also. When the price level is rising, first in first out means you are transferring older lower costs to CGS. CGS is lower here, and you are transferring higher cost to closing stock. This ratio. First in first out means you are transferring older cost to production. Latest cost, higher cost become part of your assets. So your current assets increase, current liabilities stay the same, the ratio increase. This is what is happening in FIFO. If you move to LIFO, things will totally go in the opposite direction. How? Price level is rising. You are charging last in first out means higher costs, higher prices to production. Resultantly, your cost of goods sold is higher. And you are transferring your older, lower cost to inventories, so inventory figure is lower. This will cause the ratio to go up. If you come on this side, last in first out means latest, highest cost items, expensive items, they go to production. Resultantly, your inventory figures on the balance sheet are older, lower costs. So your current assets are showing at lower costs. This will happen totally opposite to what you see to the left of the screen. So that means if you move to LIFO, your current ratio would decrease, you can see that, and your inventory turnover ratio would increase, you can see that. While this video would be available on the LMS, pause it, think about some information on your head, put some numbers maybe, then it will make much sense. Lancaster Incorporated had net account receivables 168 and 147 at the beginning and end of the year. Opening closing is given. The company's net income for the year is 204,000 and 1.7 million in total sales. That's net income, that's sales figure. Cash sales are 6% of the total. Lancaster's average account receivables turnover ratio. Account receivable turnover ratio. We need credit sales, which is 6% is cash, 94% is credit. So 94% of 1.7 million, if you calculate, it's 1.598 million. Average receivable that will involve opening and closing to be added, divided by 2. 168 plus 147 upon 2 gives you an average of 157,500. This 157,500 will serve as the denominator of this ratio, because the formula of average account receivable turnover is credit sales divided by average account receivables. So 1,598,000, 157,500 gives you 10.14603, which if rounded off gives you 10.15. It's a perfect match for your option B. Assuming all sales are credit, days sales outstanding in account receivables. In other words, you have to find average collection period. The formula is simply average AR divided by net credit sales times day, which is 360 in this question. So do we have credit sales? No. Do we have total sales? That's the number you can use because credit sales isn't given. Do we have average AR? Yes. Net receivables 68 opening closing. I really would like to have gross receivables, but that is not available. So 68 plus 47 over 2, that is 57,500. This is the average figure for your account receivables. So 57,500 is the average number times 360. And if you simplify this, it gives you perfect 23. This is your average collection period, perfect match for option B. The following financial information is given for Anjali Corporation in millions of dollars, sales for both years in millions, cost of goods sold, current assets in form of cash, account receivables and inventory, What is required? Between the prior year and the current year, did the days sales in inventory and days sales in receivables for this company increase or decrease? Assume 365-day year. Right, let us first find out the days sales inventory average collection period for both years, prior year, current year for short. Average collection period is your receivables divided by sales, that is 3 by 10. 3 by 10 multiplied by 365, it gives you 109.5. What about the current year? Current is 4 by 11. 4 by 11 times 365 gives you 132.73. So your average collection period has increased. First it took you 109 days, now it takes 132 days. What about the inventory turnover days? We call the days sales in inventory. For this you take the inventory figure 4 CGS 6 4 by 6 into 365. Same formula, I'm not doing something new. It's just that in extended form and there are information that is quite jumbled up. 4 by 6 times 365 is 243.33. The next year 5 by 7. 5 by 7, that is inventory over CGS times 365. 260. See, absolutely right. All of you got it right. So your average collection period is increasing, your inventory turnover days is increasing. So both are increasing and that is option A. See, 109 to 132 and 243 to 260. And the formula you know very well. Our company has net sales of 3 million, average fixed assets 1.3, total assets 2 million. What is fixed assets turnover? Mind the word fixed assets turnover. Fixed assets turnover is sales over average fixed assets. We don't have average, so whatever we have we can use. Sales $3 million. Fixed assets 1.3 million. Fairly straightforward computation, that gives you 2.3. So what it means, we got the answer 2.3, matches perfectly with option C. It tells you that if you have $1 of assets, fixed assets, those $1 fixed assets have generated sales worth $2.3. Or sale is 2.3 times of the investments in fixed assets. How good we are compared to others, we need to compare the fixed assets turnover for other businesses or for the industry average, right? A company purchased 10,000 shares of its own stock at the beginning of the year. Resultantly, your cash falls, which is basically your current asset. And when you buy your own stock, treasury stock, it causes your equity to reduce because equity is reduced when a company buys its own stock. So it says this transaction will affect all of the following except. Since equity has changed, debt to equity ratio will definitely be impacted. Earning per share. Earning per share is calculated using this formula. Earning per share is income available to common stockholders divided by the number of shares. Since you have purchased your own stock, number of shares fall, so this ratio is impacted. So earning per share is impacted because of lesser number of shares outstanding. Current ratio would be affected, yes, since current assets have fallen because we have used cash to buy our own stock. So yes, current ratio would be affected. Net profit margin is calculated taking net profit and expressing it as a percentage of sales. Both of these are unaffected, so the ratio that is not changed is net profit margin. Excellent result C. Right. The assets of Moreland Corporation are presented below. We have got cash for both years, marketable securities, account receivables, inventory and plant and equipment net, less accumulated depreciation. For the year just ended, Moreland had net income of 96 and 900,000 of sales. We need to find out the total assets turnover. Now this is important. Total assets turnover, TATO, is equal to sales, and ideally average total assets. Mind the word, average total assets. Why? Because it says total assets. Average total assets. So as far as numerator is concerned, that's pretty straightforward. That's the figure for sales, $900,000. Average total assets. We will combine all these assets. 48 plus 42 plus 68 plus 1 to 5 plus 3 to 5 gives us the total opening assets of $608,000. Plus closing assets 62, 35, 47, 138, 4 to 4 gives you a total of 706. So 706 plus 608 over 2 gives you the average total assets, that is 131,400 divided by 2. So the average comes out to be 657,000. So now we got the average assets, 900,000 over 657, and you get 1.36986, which is approximately 1.37. Perfect match for your option B. Perfect. Next, people. See, such questions are a bit tricky because we don't have numbers. I would always advise to use the formulas and see whether the numerator denominator is going up or down, and then go for the selection of your option. It says Interstate Motors has decided to make an additional investment in its operating assets, which are financed by debt. What we get from this information is that your assets are increasing. You are purchasing an operating asset, but this asset is being acquired through debt. That means debt is increasing. And if debt increases, that clearly means interest increases. You pay interest on debt. Assuming all other factors remain constant, this increase in investment will have which of the following effects? First, operating income margin. Operating income margin basically is earning before interest and tax over sales. Operating assets turnover, that is sales divided by assets. And return on operating assets, that is earning before interest and tax divided by the assets. Now please see, since the assets have increased, debt has increased, but since both numbers of income are before tax, because it says operating, return on operating assets, so that clearly means that we need to take income before interest. So this is not affected, no change in it, no effect, no change. But operating assets turnover, sales upon larger assets, this ratio will decrease. Earning before interest and tax over larger assets, this ratio will decrease. So we have no change, decrease, decrease. B to be the correct option, right? So it's advisable to use the formulas, use arrows this way. You will be able to conclude whether the ratio would improve or whether it will deteriorate, what way it will change. You can easily see from it. What is needed? It says, what will be the company's return on equity at the end of the fiscal year? Return on equity. We know return on equity is equal to net income over, ideally, average equity. Let's see what we have been given. A company has 450,000 in assets, 250,000 in liabilities, and 200,000 in equity at the beginning of the year. So that means we have been given the opening equity. The company's management is projecting that net income for the year will be 55, right? That's good. And equity at the end will be 210. We got what we needed. We have net income nicely given as $55,000. And the average equity is opening plus closing. Opening is 200, closing 210, that is 410. 410,000 divided by 2. So that's going to be 205. So 55,000 is your net income. Average equity is 205,000 times 100 gives you 26.829, which is basically 26.8C. Perfect. All of you got it right. Excellent. What is the cost of goods sold? It says a company has net profit margin of 5%, operating profit margin of 10%, gross profit margin of 25%, sales revenue 5 million, Selling admin expenses are total 750. What is CGS? It's a one-line question. Don't need to overdo. Try to find sharper, quicker way of doing this. Excellent, Krishnan, you got it right. Gross profit is 25% of sales. Right. If your sales is $5 million, 25% of this represents gross profit. That means 75% represents cost of goods sold. Simple. Take 75% of 5 million, that is 3.75 million, and you get the answer. Excellent. Shortcut. There's no way, no need to use other numbers, you'll simply waste your time.